Hello, Baker International Finance students. Hope everyone was doing well. Had a Baker faculty meeting this morning via Zoom, so that was kind of unique. In my 25 years of teaching at Baker, that's the first time I've ever had a virtual faculty meeting, but we spent the morning kind of going over some of the differences in virtual environments, and we obviously are asynchronous in this course, but there's some changes to APA out there too, the 7th edition, so eventually at some point, I think it's a later point, maybe June 2020, that your courses are going to start to require the 7th edition of APA. And a lot of the changes are minimal. It's just like you don't need a writing head anymore. You can do et al. On the first one with multiple authors. Another thing I'll just kind of suggest too, when you do APA, it's supposed to be double space. You really need to kind of like highlight the entire document and select the double spacing option, because in Word, when you do a paragraph return, it doesn't really make a double space, but that's just a little minor thing. So, all right, so this week it's Saturday night, and I'm just doing this a little bit early because I got to do a ton of writing for my work at KU tomorrow to stay on top of things so I can get my course wrapped up by May 2nd. Right now I'm studying all the financial issues in the state of Wisconsin to higher education, so it's kind of interesting. But so with this week, we're going to repeat again, rinse, repeat. So you're going to have the forum discussion. Good job with that. Continue to do that. Jump in there early, post. You're going to have the homework, and then you'll use the template for that, and then also the quiz, which you get multiple temps on. So this week you're going to look at Chapter 6, International Parity Conditions, a lot of theory. It's a little bit of technical reading. And then you're going to look at foreign currency derivatives, such as futures and options specifically. Spend a lot of time in that. You've probably done this before with the different courses, with hearing about derivatives. Derivatives derive their value from some underlying asset. And if you had me before, I said that as long as you have that underlying asset, it's okay to use the derivatives. You're kind of using it as an insurance, but if not, if you don't have the underlying asset, you're just gambling. So it's high risk, So, and I think somebody had posted this past week about the trading on currencies, the increase. Maybe more people jumping online and doing this now that they're home more. So anyway, to go over Chapter 6, a little bit of review here. This is a little bit of technical reading, so just kind of take your time through it. But they start off with a quote by David Ricardo. He's one of the famous classical economists, that dealt with the Corn Laws out of Great Britain and kind of this idea of exchange. And especially out of this Chapter 6, we're making a lot of assumptions about parity. I'll give you an example. Let's say that you were an entrepreneur and you knew that you could buy cigarettes in Canada at much lower price and import them into the United States, which you can't. It is highly illegal. But if you could do that, entrepreneurs would see that and try to make a profit. But imagine all the cigarettes left Canada. So there's a shortage in Canada now, so the price is going to go up. And now there's more cigarettes coming to the United States. The price should drop, and you get to a point of equilibrium. But in reality, not all things are that easily tradable. The textbook gives the example of the Big Mac or a haircut. I don't have to worry about that. But and there's also going to be different elasticities of demand for different types of goods. And you're going to read about that in the readings. But some of the things I want to point out for this chapter is, like that example, like the Big Mac index. That's something the Economist magazine has been measuring for since I think 1986, and they use that because an idea in theory is that a Big Mac you buy in the United States should be the same Big Mac you buy in Paris or China, because they're big about consistency. So the idea in theory is that if a Big Mac costs $5 in the United States, you should be able to swap your dollars for the Chinese renminbi, go and buy that, and you should have exactly the right amount of money to buy that. But we know that it's not the case. And in fact, when they do the example in the textbook, I think they did it with the yen to the dollar. It was saying that it was, the Chinese yuan, the Chinese yuan, that was undervalued. It was much cheaper. It was like $2.79. But they're using it as kind of a predictor of what exchange rates, a lot of this chapter is determination of future FX rates, and again, this whole idea of like Eugene Fama, efficient market hypothesis, doesn't really hold true. Okay. Some other things you're going to look at above too is you're going to look at the concept of like pass through. They gave the example like the Volvo in the textbook. Say if the euro had appreciated, a Volvo would have been 50,000 euros or dollars, and you had to pass it on to the euro appreciating, went up to 60,000. If there's full pass through, the U.S. consumer would pay the full price. But if there's only partial pass through because they're worried about elasticity in demand and sales, they may not jack the price up to the full 60,000. It may only go to 58,000. So you're definitely going to cover elasticity of demand differences. You're going to look at interest rates and FX rates. This is called the Fisher equation. If you were kind of to look at this mathematically, it's 1 plus the nominal rate divided by 1 plus the inflation rate minus 1. That gives you the true rate of return. If you've taken a finance course, you've probably heard of the Fisher equation before. But the quick and dirty is just saying nominal rate minus the inflation rate gives you the real rate. Okay. So with this, they kind of gave examples, like with the Japanese bond at 4% and the U.S. bond at 6%. And they kind of walk through these examples that says, hey, really, either way that you should be indifferent. And when they're looking at some of these things, especially making these decisions about futures of interest rates, there should be this interest rate parity that exists. That investors should see through this, and if there's opportunities that exist, entrepreneurs would quickly recognize this, engage in trades to get to a point that we quickly disappear. So you're going to read about these examples. They had like a covered interest arbitrage that I kind of sell forward to make sure I get that amount. In fact, in that, I think it was on that figure 6.6. I just want to point this out, what they're doing. If I can get to that exact figure, find that page. Yeah, so I just want to point out at the bottom of page 164, how they got to the 1,019,993. What they're doing is they're taking 1 divided by 1.4655, and they get 0.6823. Well, they take that 0.2683, they multiply it by that 1,494,800 Swiss francs to get that return. But what they're showing in the flow is kind of like either way, you'd come out the same. Okay, so if there is parity, and again, we know that parity doesn't always exist. That prices and interest rates are not the same. But if you could speculate on these things and kind of recognize quickly in markets that, hey, I can convert this, invest in this security at this bond, whatever the interest rate is overseas, convert that currency, get my dollars back, I can make a profit from it. So, okay. I think that's pretty much everything I want to cover in some main highlights of Chapter 6. Chapter 7, look at my notes. I've talked about already the idea of, that a derivative derives its value from some underlying asset, and why we would have, trying to manage for FX risk or foreign exchange rate risk is, that if I have to buy euros 6 months from now, or I'm going to receive euros and I have to convert those to dollars, I want to make sure I'm protected. So, depending on which side of the transaction you're on, you may want to do a futures contract, or you may want to do an options contract. So the futures contract, some of that terminology, again, it talks about, mark to market. We price it, based on changes in the spot rate. You have to have a deposit account called a margin account. So if it moves out of your favor, you're going to have to add money to that margin account. But if it moves in your favor, they will add money to that margin account. Basically, 2 positions. You can go short. You're betting that the price of the currency goes down. Or you can go long. You're betting that the price of the currency goes up. So they walk through some examples, like with the Mexican peso there, with 500,000 pesos, where somebody went long and they made $210 in the textbook. Some of the other things I want to make sure about the options. So think of a call, the right to buy, and put, the right to sell that currency. So let's try to think about an example here. So I know that I'm going to receive euros 6 months from now. I'm worried about the price that I'm going to get for those euros. what would happen, if the euro depreciated in value? That would mean I would get less dollars. Well, I could do a put that would guarantee me that I'd be able to sell those euros at a specific price. Of course, the underwriter that writes the call or the puts are going to write it in a manner that they're going to hope that the investor doesn't cash in on it. Now, some investors do, but you're trying to predict which way it's going to go, and they're trying to cover themselves. And the textbook talks about in the money and out of the money. So if it's in the money, the option has value. If it's out of the money, you would not exercise it. So um, the underwriters are trying to forecast what they think is going to happen to these and price them accordingly. Of course, the investor is trying to protect themselves, so they may want to make sure, hey, I'm worried that the euro is going to depreciate quite a bit, so I'm going to protect myself by buying a put. So you're going to read through some of the quotations in the textbook there with some of the examples. They get a good example of a walkthrough on a cost of a contract on page 192. And the last thing, just kind of wrap up with this this week. They talk about the premium values on these contracts. You can go through and kind of look through. They had an example, I think, in the textbook for the different prices on those securities. The forwards, or excuse me, for the options. The different premiums, because the farther in the future, the more the uncertainty. But some options may have actually priced in a present value to them that gives them a little bit of a premium too, that somebody might be willing to buy it before it matures. So they talk about this intrinsic value and time value in the textbook. So, okay. You'll read a little bit more about options price sensitivity, forward sensitivity, and the time to maturity sensitivity and volatility. They call it lambda. Okay. And sensitivity changes interest rates, rho and phi. So, well, that's pretty much it for this week. So I just want to give you a little bit of insight. I'm going to post this a little bit early just because I said I have to do a lot of writing tomorrow. But if you do have any questions, do send me an email. Usually can get back to you the following day at the latest. But otherwise, have a great week, and I look forward to talking to you online. Take care.